All right, today we are cracking open the modern investor's playbook. We're going to look at a whole new class of information that's moving from the sidelines right into the center of the action, giving professional investors a really powerful and, honestly, pretty surprising new edge. So think about it. In a market where pretty much everyone is looking at the exact same financial reports, how do the best investors actually get ahead? Where do you find an advantage when the old playbook is basically common knowledge? Well, the answer isn't buried in some obscure line item on a balance sheet. Nope. It's found in sustainability data. You probably heard it called ESG for environmental, social, and governance factors. And believe me, this is the new frontier for financial analysis. Okay, but let's just tackle the biggest misconception right off the bat. For the vast majority of institutional investors, this is not about personal ethics or just doing good. It's about something way more fundamental: driving financial performance. For decades, investing was driven almost entirely by financial statements. That was it. But that view, it's kind of obsolete now. The new way of thinking recognizes that how a company handles things like sustainability is directly tied to its long-term value. It doesn't replace financial analysis, it just makes it a whole lot smarter. So, what's the real motivation here? It's all about getting a more complete picture of a company's health. Investors are using this data to manage risk, to spot those early warning signs of trouble, and ultimately to find opportunities that lead to better, more stable returns. It is a purely pragmatic, financial-first approach. Of course, not every investor uses this information in the exact same way. The best way to think of it is like a toolkit, with different tools and strategies for different goals. So let's break down some of the main approaches. So one of the most powerful tools in that kit is something called ESG integration. Now, this isn't some separate siloed strategy. It's about weaving material sustainability data, and by material, I mean information with a clear financial impact, right into the core of how you'd normally analyze a company. The whole goal is to find risks and opportunities that would otherwise stay hidden. This chart here lays out the entire landscape perfectly. See, over on the left, you've got values-focused strategies like impact investing, which are really aiming for a measurable social good. But on the right, you have value-focused strategies like the ESG integration we just talked about. Our focus today is squarely on this right side, the tools designed purely to drive financial performance. So let's break down 3 of the main plays in the playbook. First, negative screening. This is the oldest approach. You just exclude entire sectors you don't want to own, like tobacco. And there's thematic investing, which is about focusing your capital on a specific trend, like, say, renewable energy. And like we just discussed, ESG integration is the most comprehensive, weaving this data into the very DNA of the whole investment process. So how do investors actually use this playbook in the real world? Well, it all starts with the pre-game analysis, way before a single dollar is ever invested. Now take a look at this. This finding from Bank of America Global Research, it's just staggering. I mean, think about that for a second. Avoiding over 90% of major corporate bankruptcies just by screening for sustainability scores. This is not about having a crystal ball. It's about seeing giant red flags that traditional analysis often completely misses. So here's the key takeaway. Strong sustainability performance is often a really good proxy for operational excellence and just plain smart risk management. It basically functions as a powerful early warning system, helping investors sidestep companies that are built on a shaky foundation. Okay, now let's zoom out a little bit. How does this apply not just to picking one company, but to building an entire portfolio, especially in the world of big index funds? 2 key techniques really dominate here. A tilt is when an index fund decides to overweight its holdings toward companies with strong sustainability characteristics. And a screen, like we saw earlier, is used to just straight up remove companies or even entire industries that don't meet certain criteria. It's all about shaping the portfolio at a macro level. All right, now here's a number that reveals a really interesting kind of hidden advantage in portfolio design: 51%. So what on earth does that mean? Well, that was the average reduction in risk correlation that a Yale study found. Here's what that means in simple terms. By grouping companies based on the sustainability risks they share, things like water scarcity or labor issues, instead of just what they sell, you can build a much more diversified portfolio. Less correlation means less risk of everything collapsing at once. It's just a fundamentally smarter way to diversify. But the game is definitely not over once the investment is made. For modern investors, ownership is an active process. This is the post-game plan, engagement and stewardship. So, you've done all your analysis, you've built your portfolio, you've made the investment. What happens now? Do you just sit back and relax? Not at all. They enter this active engagement cycle. They're constantly monitoring performance, identifying weaknesses, and then they engage directly with the company's management to push for improvements. See, the goal isn't always just to sell off the laggards. It's often to help good companies get even better, which protects and enhances the investment's value for the long haul. So, we have covered a lot of ground here, from risk analysis to portfolio construction to active ownership. But every single one of these advanced strategies rests on one absolutely critical foundation. And that foundation is data. Without high-quality, comparable, and reliable information, this entire playbook just falls apart. It's that old saying, right? Garbage in, garbage out. The quality of the analysis is only as good as the quality of the data that's feeding it. And that brings us to the biggest challenge in this space today. The data is still pretty messy. Different companies report different things, and the ESG rating agencies, well, they often disagree with each other. In fact, get this, the correlation between their ratings is only about 0.61. To put that in perspective, the credit ratings for Moody's and S&P are correlated at 0.99. That huge gap shows you just how hard it still is to separate the real signal from all the noise. And this all leads us to our final thought for today. The push for standardized, reliable sustainability data is getting stronger every day. So, as this information gets better and becomes more integrated into the market, are we going to reach a point where a company's sustainability score becomes just as important as its stock price? That question could very well define the future of investing. Thanks for watching.